provocative question. Salary can't make you rich. What can? Not many people think in these terms because our first objective in life is to come out of colleges and go and get a good job, right? And then, of course, the next objective is to leave that job and try to get a better job so that you get a 30% hike in your next one in a few months or years. That's just the starting point. And in fact, in a whole career of maybe 25, 30, 35 years, you will be surprised to know, and this is a calculation that you can do yourself, you will be surprised to know how much of your eventual wealth is not going to be your regular income. It's not going to be contributed by your regular income, but the money that you save and the way that the money grows on that money that you save. So it's money on money, right? So that's my central point about this, that don't just look at how much you earn. The far bigger issue is that how much you save and where you invest, so that in about 15 years' time, you are fairly comfortable with the kind of money that you invested and the money that is grown to. Unfortunately, a lot of people do not have the benefit of this. I mean, certainly we didn't. And in fact, in every single event that we conducted, every single investor conference or seminar we have conducted here or outside Mumbai, at least two to three persons have at least have told us that we wish we were exposed to something like this when we were young. And you are young and you got exposed to this, so please, you don't have any excuses to make. You don't have to make the mistakes that we see in every household all the time. As I mentioned, the moment we earn money, obviously we have money to spend. Either it's things that we need to buy or the essentials and so on. After that point, it all starts getting very complicated. Some people overspend, so they're borrowing, which is terrible. Some try to buy a property. Everybody likes to buy a house. It's one of the first things that we want to own. So they borrow, and it's a great thing. It's a good thing. In fact, if there was no borrowing, none of us would be able to own a house. Unfortunately, we are in the grip of builders, and builders are not going to reduce prices because they have the leeway, they have the opportunity to keep raising the prices. They have the politicians in their pocket. They have sort of supply is less, so eventually we are forced as savers to be able to shell out money to them to pay the price that we are demanding. The unfortunate result of this is that a large chunk of lot of people who are in middle class today, a large chunk of their savings, large chunk of their income is going into paying EMI. There is no easy answer to get out of this, but if you do have an opportunity, if you do have an option to reduce the home loan EMI, you should definitely stay focused on that, because while the place that you're investing in, that you bought, is a home, it's an asset, so it gets accumulated. If the price increases over a period of time, please remember it's an illiquid asset. It's not an asset out of which you can do anything other than live in that. The only time you can benefit from that asset is when you sell it, all right? And you haven't bought it to sell. You have not bought that asset to liquidate and sell at a higher price. You are living in that, so don't treat it like an investment. It's a spending which will grow. It's an additional source of security if there is something bad that happens. If after paying EMI and expenses, money, first of all, the salary checks comes into the bank. So it's lying in your savings account. Human beings are terrible in taking action. We procrastinate, even I procrastinate. All of us delay taking a decision until the last minute. Same with our studies, same with our money. All the effort that you put in to earn that money, the large chunk of that money will be lying in savings account. People then take the next step of, some of us are a little more proactive, so they'll say so much of money lying in savings account earns only 4% interest. Maybe if you're in Kotak Bank or Yes Bank, it earns maybe 6% or 7%. So some of us take the step of putting into an FD. But an FD also earns only about 8.75%. And if you're in a tax bracket, you would pay tax on that. So your post-tax 8.75 comes down to 5.9 or something like that, all right? Or 6 point something after paying tax. So it's not earning much. Inflation is 9%. Your money is earning 6 point something. So every year, by keeping the money in a bank FD, you're losing money. You still need to keep some money in bank FD because that's security. But if you keep too much of money over there, you're missing out on an opportunity to earn much higher returns in other products, right? So that's still not bad, and that's all that is explained in my following slide. But what a lot of people tend to do, and this is something you have to guard against. Around March, as part of the same story of procrastination and waiting and delaying our decisions, suddenly your accountant tells you, hey, listen, I'm going to deduct all this money as taxes if you're in the tax bracket, if you do not invest in certain specified investment products. So people panic, and the first investment product they buy is a insurance product. Some insurance products are even worse than bank FD. We did a cover story which said that HDFC Life had an insurance product which gave you 2% per annum. 2%. That is if you kept till the whole term. You want to withdraw in the middle, you got nothing, literally, because there are surrender charges. So, if you do not make any of these mistakes, as I mentioned, your money is still in bank FD. Now, all of you have a chance to make the story different in your case. In each of your case, you don't have to do what others have done or what I have done. You have a chance to make your story different. A lot of people definitely do tell you, but there is no getting away from a simple arithmetic to keep your costs under control. You just have to find a way to postpone certain expenses over to a future period. And I'll show you how incredible the small decisions of postponing certain costs are. These are roughly the costs that a household normally has. Please do calculate this. Once you start earning money, please do this. Make the simple calculation. There are online calculators and tools that are available. They are free. We also have one in our website. It's free. A lot of people provide this. If you ensure that at least 25-30% of your money is not spent, just saved after everything. After all, if you bought an insurance premium, after premium, you bought a home loan, then after EMI, after all of that, this is the money that every month you still have 25-30%. You are in a very good position because this money can then grow eventually to a very, very large corpus. Believe me, you'd be surprised to know how much this can grow over a 25-year period. Some of you, if you follow this around 40s, you may not have to work anymore. It's that kind of a powerful long-term effect that this money has. Also, by way of a simple simple measure, if your expenses, let's say this is 30,000 is your income, all right? So I'm saying 30% of that, or 9,000 rupees, should be your savings, which you want to invest, and I'll share with you how to invest that. Let's say 21,000 is your expenses. The 6 months of that, 1,26,000, accumulate, keep it in bank FD. This is your emergency money. This is a simple thing which everybody will tell you how to do. What to do with that 9,000 rupees? It's absolutely simple, and a lot of people try to make it into a very, very complex decisions. The financial services companies try to make it very complex for you because they're throwing constantly different products. They are advertising, there are distributors. You get bombarded with all of them. You don't need any of that. All you need to know is what to invest in, and there are just 3 or 4 very simple products that you need to know about, and they depend on your goals. If it's a long-term goal or a short-term goal, depends on what your expected returns, meaning how much these products, and I give you a little glimpse of that. Bank deposits, if you are taxed, will give you 6 point something. All right. So I'll give you a little chart which will show you what is the returns to expect from different kind of investment products that are available, and we need to choose a mix of these. We also need to choose products depending on volatility. Why am I saying this? Because bank FDs are not volatile. Whatever you invested in, you're going to get back. But some investment products are volatile. You invest 20,000 rupees today, tomorrow they can become 19,000. 6 months later they can become 25,000. All right, the returns are higher, but they go up and down. These are called market linked instruments, depending on your time frame. If you need it only for about 3 months, certain products to choose. If you can afford not to sort of touch that money for 6 years, then it's a different product to choose. And finally, depending on your tax position. I'm not going to touch on the tax part because it will get a little complex, but that's very, very easy. So that was the first set of factors to consider and when to invest. Sometimes timing is important, sometimes timing is not important. And how much to invest, which technically, you guys do finance? So you would have heard of the term called asset allocation, which is simply spreading your money across different asset classes. But that's all. There's nothing more complex than this in terms of investing. And you can sort of spend your time doing anything else rather than learning anything about personal finance. Go back to that first point, as per your goals, alright? So this is what I'm explaining. So you need to buy an apartment, take a home loan, these other particular policies. You need to buy life insurance, only look at term plans. And especially online term plans. You don't need to look at anything else. Health insurance, there is specifically for health, and rest of it is all long term, essentially tax saving instrument. This is very, very important. If you're going to be in the tax bracket, there are 4 or 5 products you need to look at that, and that's about it, which is public provident fund, which if you're borrowed for a flat, 2.5 lakhs, up to 2.5 lakhs you get as a deduction against your income. So you take that, you take 1,50,000 public provident fund, and that's about it. Don't bother about anything else. Rest of the money, then you can start looking at long-term investment. This is as per your goals. Second one was as per your expected returns. We all love to know how much mileage our car gives, so I just put it over there. Sensex, that is stocks, up by 14% post-tax returns in the last 20 years. Gold, 9% compounded over 20 years before tax. You need to pay 20% long-term capital gains tax. Alright, and that 20 years, of the 20 years, gold has encompassed a 10-year incredible period of rise. The first 10 years was nothing. Next 10 years, this gold went up very, very sharply. If you buy ULIPs, you're going to get just about 6 to 8%. It's no big deal, probably lower. This is an average return. If you are able to choose the right kind of ULIPs, a lot of hard work is needed, avoidable. Bank FD, as I said, 8.75, after 30% tax, 6.2%. Traditional insurance plans fetch about 4 to 7, probably less. Real estate, nobody knows. For all this, I have data going back 20 years, 15 years. I have no data for real estate. The government has just started collecting the data, and that data is suspect. The big problem about not knowing what is the estimated return from real estate, because the two flats are not comparable. Whereas Reliance, which is listed in 1986, you can check the price and check the price today. They're the same company, prices are comparable, adjusted for bonus and dividends, etc. Third point to remember, if you go back to that earlier slide, third point to remember was volatility, right? And then we'll go to time frame. So usually a lot of us plan fairly smoothly. When I say 14% Sensex last 20 years, looks like one nice straight line, but it won't be like that. It will be more like this. In some years it's good, 3-4 consecutive years it can be great. It was between 2003 and 2007 or 2008, and then market falls and it goes up again. But that 14% was an average figure, long-term figure. And remember, the great thing about stocks is that it is tax-free. Anything more than 1 year is long-term capital gains, it's tax-free. It's been like this, and it probably will remain like this forever. So, if you were to look at any short-term period, you would want to avoid anything that's volatile, that goes up and down. The smoothness comes only over a period of time. If you're able to buy it, even if you were to buy here and then fall, then it comes out. So you have to give it that time. That's absolutely critical. If you don't have that time, or if you're investing on anything for a shorter term goal, just avoid anything that is volatile, whether it's stocks, whether it's bonds, whether anything that's market linked. Because you just never know what is going to happen 6 months down the line. Time frame. The fourth point. This I've already covered, but let me repeat. 0 to 3 years. This is based on the kind of analysis that we've done, based on past data. Capital has to be protected. Time is not on your side. Value should not fluctuate. So, fixed income products. Anything more than 3 years up to 5 years, you can start getting little bit of risk products in that, where the returns are a little higher. And risk products do very well, the best over more than 5 years. So our analysis points out that almost 87% of the time, we've looked at a probability distribution of returns over any 5-year period. Because you don't know when you're going to invest. You listen to this, you may start after 6 months, you may start after 1 year. So no matter when you start, what happens to the next 5 years, 87% of the time you do not lose money by investing in good quality stocks or good quality equity mutual funds. So roughly, this is how you can match your time frame with the goal with your products. When to invest? Answer is very simple. You earn every month, you spend every month, you will invest every month. There's absolutely no getting away from it. A lot of people who come to our seminars, they have 2 questions to ask. Is it a good time to invest? 1, and second, which stocks to buy or which funds to buy, right? So both are not really strictly relevant if you follow a certain time frame and over a period of time. And believe me, this is really the heart of the presentation. It's for younger people, and you will be surprised. I mean, I'm sure you know, but you will be surprised to see how much, if you actually put this data in a calculator, in an Excel calculator or in any sort of online calculator, you would just take a 10% return, put 25,000 or put 10,000 rupees of investment every month, increase it by 10% every year. So your first year, I've not done a 10% increase here. Do this calculation. First year 10,000, next year 11,000. That is your investment level. And calculate a 10% return on that a year after year. You will see the amount of money that you make over 15-year period or 20-year period. Compounding, to explain, suppose somebody is investing just 1,000 per month or 12,000 a year. On that, if that person earns 10%, that is 1,200, end of the year, the value goes up to 12,000 plus 1,200, 13,200. Next year, this person will put another 10,000. So 10,000 gets added to this, alright? So the investment becomes 25,200, 10% on that, 27,720 is the value at the end of the second year. If this continues for 30 years, every year 12,000 has been put, 3,60,000 has been invested. The return would be 21.7 lakhs, which means 18 lakhs has not come from principal, has come from income on income. This was my first point. Salary doesn't make you rich. It's the investment that make you rich. Look at this chart. The graphic representation of what I mentioned before. Green part is the principal investment. 12,000 every year goes up to 3,60,000. The actual value is going to go up to 21.7 lakhs. Huge amounts of money, and it starts actually building at a very slow pace. At the end of the 7th year, you will be cursing me, what is this crap he has talked about? But see the acceleration that happens later on. That's how compounding actually works. How much in what? Asset allocation. Very simple. For younger people, 20 to 25% has to be in fixed income, the rest has to be, I've given a range, 20 to 35. Depending on if you feel that 20% is just too little or 80% is too much for equity, you can choose. But if you follow this 80-20 and you do a simple calculation, if you get 14% return, which I talked about in Sensex, even if you get 14% return on the 80% part of your portfolio, alright, you're making 11.2%. And if you get 8% return on the 20% part of your portfolio, you get 1.6. 1.6 plus 11.2, 12.8%. I have assumed only 10%. So you do 12.8% compounding, the figure is going to be so phenomenal that you will retire thanking me when you are 40. Equity mutual funds earns the highest return, beats inflation, creates wealth. The reason why we need to take that into account is the killing effect of inflation every single day, every single minute, which we do not realize. If you start with 1 crore of rupees at 7% inflation, the value of your money is down to 11 lakhs after 30 years. You start with 1 crore of rupees at 10% inflation, the value of your money is down to just 4.38 lakhs after 30 years. You invest in a product that beats inflation, that is more than 10%, that is more than 7%, you can reverse this process. You can protect your wealth and the money grows through compounding. A lot of people do not understand this and are happy to see a lot of money in the bank FDs. For them it's a killer because they're getting low returns and they're facing high inflation, which effectively leads to a capital loss. It's a different kind of loss. It's not an absolute loss. It's a relative loss of purchasing power. What is the inflation rate now? 9.36. CPI urban. That is consumer price inflation urban. Effective inflation is how much? Nobody knows. My guess is it's 11% plus. Because the inflation that affects us, the items of expenses that affect us is not calculated by the CSO to calculate the inflation and show it every year. I mean, till about 18 months ago, you didn't have a CPI urban and rural, which you have today, right? I've gone through this round question most people ask when to buy and so on. Real estate I've touched upon very briefly. I'm not going to go into gold, but real estate I will, because a lot of people tend to think that real estate is good investment option. Well, to start with, I say I don't know. The reason I say I don't know because I have no data. What you will hear is stories. You will hear some cousin of yours who bought in something in Bangalore or in Pune and Hyderabad and in 2003, very nicely, when the market was an absolute low, and you will see that the property they bought is about up 7%. The fact is, real estate prices can go down in India. Nariman Point was 10,000 rupees a square foot in 1992. In 2003, when I had a small office over there on rent, the price in Nariman Point was 8,500. It was 1,500 or rather 15% down between 92 and 2003 over 9 years. Alright, this can happen. If you want to know why this happens, I can take it in the question session, but there is a solid logic why this can happen. For all the stories that you hear about people having made a lot of money in real estate, there are equally large number of stories of people cheated by builders, bought and sold at the wrong time, bought at such high prices, the example that I gave, that there is absolutely no appreciation, huge costs to maintain, to get that appreciation, which is brokerage, registration, stamp duty, maintenance, eat up a lot of appreciation. So I say it is the largest asset that we buy in our lives. We buy, at the end of the day, the property is the largest piece of asset. In fact, we did a very interesting compilation of data. We picked up about 12 families who were featured in a publication called ET Wealth. And so they do a profile of a family every week. And I go through it, and suddenly it struck me that there is a certain pattern in them. So I asked one of my colleagues to pull up the data across 12 or 13 such families. And in each case, I noticed that almost 50 to 60% of family income is going into paying home EMIs, home loan EMIs, right? It is going to be the largest asset. It's such a large asset that some people do not have any surplus money to invest at all. The other day I got a mail. It's quite serious. The other day I got a mail from a lady who's a Moneylife subscriber. Her family income is 65,000 rupees. They do not stay in Mumbai. They're in Hyderabad. After moving into a new flat, the EMI will be some 25,000 rupees or so. So she'll be left, the family will be left with 5,000 rupees of surplus. And they have a kid. So all expenses, all future expenses has only one and only one source: the surplus that you have at the end of the month. There is no other source. If you're a doctor, it's another matter. If you're a professional, it's another matter. If you're a rock star, it's another matter. But if you're a salaried employee, you have only one source to do everything, which is your monthly surplus is the source for you, the path that I talked about, whether it's apartment or a new car, or when you have kids, their education, their marriage, and your retirement money. I haven't even gone into this session because most people can't even see beyond 2 years. If I tell you how much money you will retire with, you will go off to sleep. So who cares about retirement now? But that retirement money, which should last for 25 years thanks to better quality healthcare that we have. My father is 90 plus, alright? And you go to any party anywhere, you will see older people perfectly fine, and then you can do knee surgeries and so on, they're climbing mountains. You will have people 80 plus everywhere, perfectly fine. So if you retire at 60 and you live till 85, you need 25 years of money. If you're not a professional, which is my basic assumption in all of this, you have no source of income. If you join a government job, that's fantastic because you have indexed pension, alright? And it'll last forever until you die. But even that has changed now. All new government employees are now compulsorily in NPS. And NPS is not going to earn anything because 80% of the money is going into debt. Only 20% will go into equity. It's a reverse. Rather than 80-20, it is 20-80. But that's a different story. Fact is that you need to fend for yourself for 25 years or more. Now, what is the source of that? Savings, invested. Part of that investment, then you will draw down for big events. Part of the investment will continue, will give you a retirement, your retirement goals, right? So, if you are forced to put so much of your savings into real estate, at the end of the day, you hope that 25 years from now, you have a product called reverse mortgage, which is very popular in the US, which is not popular at all in India, so that you can give your property to the bank, and instead of paying EMI, you get EMI. We just hope that 25 years from now, this country will be in a better position to give you the reverse mortgage option, because you will retire with this huge asset with you, which will inflate over a period of time. The other product that I need to touch upon is insurance is investment. We run 3 helplines. There are free helplines on insurance, on mutual funds, and on legal issues. The largest number of complaints come for the insurance. Some of these stories are sickening, the kind of stories that we get to hear. The other day, just Google for Allahabad High Court order on a case, on a product sold by SBI Life. This man had invested some 50,000 rupees per annum or something. He's left with some 228 rupees. After all the mortality charges, upfront commission, and whatever charges SBI Life has put, he has no money. The court was so angry, Allahabad High Court was so angry, they asked IRDA to investigate and ban a product like this. Alright? Now, this is happening to people who are educated, who can figure out what to do, or who can at least Google and find out what is good or bad. Now today, fortunately, there are many organizations like us in this area who are talking the right things, who are telling people buy a term plan, don't buy insurance as an investment. There are lots of blogs. There is a blog called Jago Investor. There is a chap called Subramani. There are a lot of people like us who are saying the same thing. Don't buy insurance as an investment. Unfortunately, people either don't read or they're probably not reading English. So LIC and people like that are having a field day. Insurance as an investment will never work for the simple reason that the business of an insurance company, apart from to offer a life cover, is to invest your premium. So the premium that you're paying them every month, they are investing for you. They are your wealth manager. Alright? So your money, if it's ULIP, your money, some of the money is put into stocks. And stocks go up and down. People have lost money, so nobody is buying ULIPs anymore. They are buying other products, which is called, in the jargon, it's called traditional insurance plans, which is money back, which is endowment, which is whole life policy, those kind of stuff. There's no stocks. So how does it work? You pay the insurance company a premium, they'll buy a debt product. An Indian debt product will give the same return to everybody. If you go out and buy a government bond, you will get 8.2%. I'm just giving an example. You will get 8.2% if you are able to buy a government bond. LIC, same 8.2%. They are not going to get 10% or 8.3 also or 8.4 also. So having invested debt products for you, that is the maximum return they can get. Then comes their costs. All of the costs of advertising, of promotion, upfront commission, yearly commissions. So the maximum income that an insurance company is going to earn is the debt income, which you can also earn by yourself. And then comes all the costs, which means the return has to be less than that. The return is 6%, 4%, 5%. That is the kind of return. With huge surrender charges, so you're locked in for 20 years and you sort of keep paying them the premium. So that's all you need to know. No insurance, real estate we need to buy. Put your money in stocks, put your money in good quality equity mutual funds, put your money in fixed income, and keep repeating the process for month on month on month. End of 15 years, you'll be absolutely fine. So if you have any other questions, please do ask. For any question apart from what you have today, register at savers.moneylife.com. The registration is free. Questions are answered free. So no matter where you are, this registration is valid. You can ask us any question anytime, we'll answer.